This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, we're now getting on to risk management proper. And the first part of risk management is foreign exchange risk management, where what's involved here is that if we are trading abroad, if we're buying goods from another country, or for that matter, if we're selling goods to another country, then there are risks involved. The most obvious risk being, of course, that the exchange rates stand to change. But in fact, there are three types of risk that you need to be aware of, and they're listed on the first page. The first one is transaction risk. And what we mean by this is, you see, I might be in the UK working using pounds. Maybe we buy goods from abroad, and I buy goods from America, and I have to pay in dollars. So, maybe I get a bill for $100,000. At the moment, maybe there are $2 to the pound. And so at $2 to the pound, that's 50,000. But the problem is that maybe, although I'm buying today for $100,000 and there are $2 to the pound, maybe I'm not going to be paying for these goods for another month. And of course, in a month's time, the exchange rate could have changed. There might be more dollars to the pound, there might be less dollars to the pound. As a result, I may end up paying more than 50,000, less than 50,000. But there is risk. Risk is the fact it may fluctuate. Maybe it's better for me, maybe it's worse for me. But clearly, because the exchange rate may have changed over the month, it's not, it might not be 50. It might be more, it might be less. There is risk. The second type of risk is what we call translation risk. And what this is, suppose I am in the UK working in pounds, but suppose I happen to have a factory in America that costs me $100,000. Well, when I come to do my statement of financial position at the end of the year, I'm a UK company, and therefore I need to do my statement of financial position in pounds. I've got this factory in America that cost me $100,000, but I'm going to have to convert that into pounds. And of course, year by year, because exchange rates change, even though the factory cost me $100,000, the pound value of it will go up and down depending on the exchange rate. So that is called translation risk. It's the value of foreign assets in the statement of financial position. Now, although be aware that exists, for the financial manager, for paper F9, we're not worried about that because it's only a book gain or loss. Clearly, if we keep the factory, we've still got the factory. The fact we may be showing it at a higher or lower value, depending on the exchange rate, doesn't actually mean we're earning money or losing money. Again, for the exam, for F9, be aware that the value is going to change, but it's only being aware. You cannot be asked to do any arithmetic on it because, again, it's not really relevant to the financial manager. The third risk of trading abroad is what we call economic risk. And this is completely different. So you see, if you sell goods abroad on credit, then of course you've potentially got more risk of irrecoverable debts. It's that much harder to collect the money. from foreign customers than it is from customers in your own country. There are also risks in the sense the political stability of the other country. Things may go wrong in the other country. Again, you're more risk perhaps of getting your money. Well, again, be aware that that's a risk of trading abroad. But in F9, it's only an awareness. You can't be asked any numbers. Any numbers in F9 relate to that. But I'm buying goods from America for $100,000. Whatever the exchange rate is at the moment, it may have changed by the time I come to pay for the goods. And so the amount I end up paying may be higher, may be lower. There is risk. It's that risk that we're concerned about how we can go about reducing or even avoiding the risk. However, before I go into the ways for the exam of removing that risk, it is quite important that you can deal with exchange rates properly, partly because different countries quote exchange rates in different ways. And look at on the next page, before the illustration. Well, I'll use the illustration. In example 1, it says A receives $100,000 from a customer in the US. And incidentally, for all of these examples, unless I say otherwise, assume that we're in the UK. So A's in the UK, receives $100,000 from a customer in America. And of course, because we're in the UK, we're going to have to convert it to pounds. The exchange rate is given as $pound 1.6250 to 1.6310. Now, 3 things there. First of all, exchange rates in real life and generally in the exam are quoted to 4 decimal places. Secondly, the way exchange rates are quoted in the exam, if it's a $pound exchange rate, it means that, forgetting all the figures, it's about 1.6. It means 1.6 of the first currency, dollars, equals 1 of the second currency, which here is pounds. So $1.6 is equal to £1. And secondly, the reason there are 2 quotes, well, I'm sure you're well aware, it depends which way you're converting. If you're paying pounds to buy dollars, you convert at one rate. If, on the other hand, you're receiving dollars and selling dollars to buy pounds, you convert at the other rate. And there are 2 rates because the bank makes a profit. They change money at one rate, change it the other way at the other rate. It's them who makes the profit. And so our question here is, we're receiving $100,000. How are we going to convert that into pounds? Well, 2 things. First of all, because we're saying $1.6 equals £1, we're going to divide by the exchange rate. Every $1.6 is £1, so divide to get the pound equivalent. The second thing is, which rate am I going to use? Well, I'll give you in a minute the rule I use. But how you remember this is up to you. Just remember that it's the bank that makes the profit, and so it's at whatever rate is worse for us. And so because we're receiving money, dividing by the bigger figure will end up giving us the lower amount. We'll convert at 1.6310, which will convert, before I say more, to how many pounds? 100,000 divided by 1.6310 is 61312. Now, I said it's whichever rate is worse for us. You see, we're receiving money, and think about it, or check on your calculator if you don't believe me. But if you divide it by 1.6250, you'd end up with a bigger amount. We'd receive more. Well, it's got to be whatever worse for us, because again, it's the bank who makes the profit. The rule I use, but again, it's up to you how you remember this, is the first rate is the rate if the company is buying the first currency, which in this case is dollars. So if we're buying dollars, we'll convert at 1.6250. The higher rate is the rate if the company is selling, again, the first currency, which in this case is dollars. So if we're buying dollars, we'll use 1.6250. If we're selling dollars to buy pounds, it'll be 1.6310. Excuse me. And what's happening in this case? We're receiving dollars, so we're needing to sell them in order to buy pounds, and therefore it's 1.6310. So do make sure you've got that. In fact, let me make up an extra little example before we look at example 2. Suppose the exchange rate was dollars to the euro 1.0500 to 1.0600. They always call the lower one first. Suppose we are in Euroland. We work in euros, but we've bought goods from the US, so we need to pay $500,000. Well, again, the way it's quoted means that $1.0506 is equal to €1. And so again, to convert, we'll take the 500,000 and we'll divide by the relevant exchange rate. But remember, we are going to be paying money. So using my rule, remember it's the first rate if we're buying the first currency. It's the second rate if the company, I'm not talking about banks buy and sell rates, if the company is selling the first currency, dollars, it's the second rate. Which way around is it here? Since we're going to have to pay dollars, we need to buy dollars from the bank. We'll use the first rate. And it'll come to how much? $476,190. Or again, if you're at all unsure, think about it, use your calculator. It's whatever's worst for us. Had you converted at 1.06, try it, but divided by a bigger number, you'd end up with a smaller number of euros. Well, since we're paying money, it's whichever rate ends up us having to pay more, because again, it's the bank that makes the profit. Finally, before we come to the risk proper, look at example 2. Now, I've put this in deliberately. In the exam, almost always, in fact, probably is always, it's dollars pounds, euros, which most people tend to have a feel for, makes it perhaps easier to get the right answer. Deliberately, though, I've put in currencies here, one of which, well, is completely invented, just to check you've got the rule. Jim Jam is a company based in India, where the currency is the Indian rupee. They owe money to a supplier in Ruritania, where the currency is Ruritanian dollars. So we're in India working in rupees. We're going to have to pay Ruritanian dollars, 240,000. But because we're in India, we want to convert to Indian rupees. We need to know how many Indian rupees it's going to cost us. Will it cost us 1,000 rupees? Will it cost us 10,000 rupees? Whatever. The current exchange rate, Indian rupee to the Ruritanian dollar, is 8.6380 to 9.2530. Well, it's two things. First of all, forgetting this spread for the moment, it's about 9. It means that 8.6, 9.2 Indian rupees are equal to 1 Ruritanian dollar. And so how are we going to convert? If one Ruritanian dollar is around 9 rupees, how many rupees will 240,000 be? Surely it can be 240,000 times the relevant exchange rate. Again, there's around 9 rupees equal $1. $1, 9 rupees, $240,000, 240,000 times 9. Secondly, which of the two rates are we going to use? I'll say it both ways. Using my rule, if we're buying Indian rupees, we'll use the first rate. If we're selling Indian rupees, we use the second rate. And what are we doing here? We're paying Ruritanian dollars. Therefore, we need to buy Ruritanian dollars. How are we going to be able to buy them? We need to sell Indian rupees in order to buy dollars. So the way I'm expressing it, it's the sell rate of 9.2530, and therefore it would cost us $222.0720 Indian rupees. If you don't like learning a rule, then again, it must be whatever's worse for us. Since we're paying money, it's whatever the biggest amount, bigger of the two amounts is. We're multiplying, well, surely to end up with the biggest cost. If you're multiplying, we multiply by the biggest exchange rate, which again is 9.2530. All right, now that in itself is nothing to do with the risk, but it is important because when we come to look at the exercises in managing exchange rate risk, it will be important you know which of the two rates to pick and how to convert. So do make sure you've got the hang of that. However, as I said, where the risk comes is that, well, look at example 2. Maybe we do owe 240,000 Ruritanian dollars. Maybe the exchange rate today is 8.6 to 9.2. But if it's the case that we're not going to pay the money for another month, 2 months, 3 months, whatever, then of course by the time we come to pay it, the exchange rate could be completely different. Maybe 10 rupees to the dollar, maybe only 8 rupees to the dollar. But that's what the risk is. Pay it today and it would be 2 million. Pay it in a month, 2 months, 3 months, maybe more, maybe less, there's risk. And so, I'll pause this lecture here. In the next lecture, we'll start going through the different ways in which we could try and avoid that exchange rate risk.